Yes, hello guys. Good morning, good afternoon, good evening, depending on where you are. Welcome to our revision part 2. Welcome to our revision part 2. That is question 3 to question 5 from the sitting April 2025 CPA Financial Management. So therefore, this is part 2 of our question. And if you have not gone through the previous one, just go to our YouTube also and search CPA Makan, and you'll be able to get all our videos that we have recorded. So go to part 2, that is question 1 and question 2 that I've already done. Go also and review the same. So I'm proceeding with the part 2 of Financial Management, sitting April 2025 CPA Kasneb syllabus. Now question 3. Go to question 3A. Question 3A, the entire of it actually, it says, the management of Talaibu Industries Limited is reviewing the company's capital investments. There are 6 projects under consideration as follows. So there are 6 projects, and kindly class, ensure that you get these past papers before you view our revision. So therefore I request you to go to our previous video on part 1 of this particular revision. You will see a link attached to that, so that you are able to download the questions and be able to follow correctly. Correct? So download the questions, then you come and view our questions. So this question is also there. So we have 6 projects: project A, project B, project C, and project D, and finally project E and F. So there are 6 projects. Under this project, actually from the topic of capital investment or capital budgeting. So in this case, we want to see how we are going to do the capital budgeting to determine the present value cash inflow. We are also supposed to determine the present value cash outflow, and we are also supposed to determine the net present value. So therefore, this topic is very important. Let's proceed. So project A, you can see project A there. Project B is also there. Project C is also there, given all the information given. Project D is there. Project E is there. And project F is there. So you can see everything is given in detail. Now I want to go to additional information so that we are able to understand clearly what we are supposed to do. Additional information number 1. The company discounts all the projects of 10 years duration or less at a cost of capital of 12%. So any project that is up to 10 years and below will be discounted at the rate of 12%. Very important. Then it goes on by saying, and all the other projects at a cost of 15%. So if there will be any project that will go above 10 years, 11, 12 onwards, you will discount that amount at the rate of 15%. Very important. So in this case, we have been given 2 discounting rates. One is from 1 year to 10 years. Then another one is from 11 years onwards, 15. Then 2, ignore taxation. In this case, we are not going to include any taxation. So therefore, it will be 0. Required A, calculate the net present value of each project. B, using calculations in A above, advise on the projects to undertaken. C, calculate the internal rate of return for projects A, C, and D. Total 20 marks. So let's begin, class. So I will begin with A. A is asking me to calculate the net present value. Net present value is given by present value cash inflow minus present value cash outflow. Correct? So this is my formula. Present value cash inflow minus present value cash outflow. I will get now the net present value. That is what I've been told to work on. 12 marks. So these 12 marks will come from this particular 6 projects. So I will go with project A. We have now project A there. Correct? So project A, we have been given already information there that are saying initial outlay of 29 million will be used in this project A. Project projected returns are as follows. So they have already made a projection on how much will be the cash inflow. So you want to convert this cash inflow from year 1 to year 4 into present value cash inflow. This one now. Then we shall subtract the cash outflow, which is now present value cash inflow. In this question, we have been given as 29%. So the cash inflows from year 1, 2, 3, and 4 need to be discounted into present value, so that now we put into our formula. So our work will be very simple. We just say here project period or a year. You can say here, cash flow. This cash flow here need to be discounted. So we now say present value interest factor. In this case, the periods are running from year 1 to year 4, and therefore our discounting rate here will be 12% because it is between 1 to 10 years. So we'll now discount this one by use of 12%. Then we shall now have the present value. So once you have now highlighted your table like that, your work will be very simple. You just say this is year 1, year 2, year 3, and year 4. The cash flows given there are in millions. So we have 8 million, 12 million, we have 10 million, and then we have 6 million. Now, we want now to find out the present value interest factor rate at the rate of 12% for us to get the discounting rates here, so that we now discount these figures. So because this is per year, we now use 1 plus r power negative n. So where n you put, if it is year 1, you just put power negative 1, you get the figure. Power 2, year 2, you put power 2, you get the figure. Power 3, you put there power 3, and then 4, you put there power negative 4, and then you work out immediately. So in this case now, our formula will be 1 plus r is 0.12, then everything power n. So wherever there is n, you put now 1, you get the figure, 2, you get the figure, 3, you get the figure, 4, you get the figure. Correct? So we have now the information as given. Now, when you press now your calculator very well using this formula here, the answers you are getting are as follows. This one you will get as 0.8929, 0.7972, 0.7118, then 0.6355. So I have now the discounting rates that I will need now to use to calculate this. So this, then for me to get now the present value, I will take now the cash flow times the discounting rate. Cash flow times the discounting rate, cash flow times discounting rate, and cash flow times discounting rate. Now when you multiply now that one, the answer you get here is 7.143. This one is 9.566. This one is 7.118, and the last one is 6.991. So therefore, I have now the present value per cash flow. Now I need present value cash inflow, which means I need to get the total of this. So when I get the total, my answer is present value cash inflow now will give me the answer as 30.818. So I have now the present value cash inflow. Then I minus present value cash outflow. You have already been given from the question as present value cash outflow of 29.000. So when you subtract, you get the net present value of how much from that point. You get 1.818. That is the answer for project A. I go to project B. I have again the project B here. Project B. So project B, we have been told also from the question. I want you to take note of question. Sorry, let me just go back to project A. Project A, the last part was saying the capital equipment purchased at the start of the project, which means at the start, at year 1 here, at the beginning of year 1 was where at the beginning of year 1 was could be sold at 5 million at the start of the 5th year. So meaning that the project, that particular equipment that was bought at the beginning of year 1 is being disposed at the beginning of the 5th year. Therefore, it means this 5 million we are being given here should be added to the cash flow in year 4. So therefore, it will be a cash flow. In this case, it will be 6 plus 5. Your answer in this case will be 11 million. Because that is, when you dispose something, it means you are increasing your cash inflow. Therefore, this 5 million here that was disposed, that was collected from that particular equipment, that was disposed, will increase the cash inflow in year 4. And therefore, the correct value is 11. When you multiply this carefully now, this times this, you get that particular point. So when you multiply carefully, you get that area. So we go to B. Cash flow B. It would involve a current cash outflow of 44 million on capital equipment and 20 million on working capital. Projected returns are as follows. You can see projected returns there. Years, sales, variable costs, contribution margin, we have the fixed cost, and then we have the profits. So it means that that table is showing you returns or figures for the accounting profits. And in this case, when we are talking about the capital budgeting, we are using cash flows. So in this case, these profit figures, we want to convert it into cash flows. And to talk about the cash flows here, we are going to exclude depreciation and any other allowance, because depreciation is not the actual cash outflow. If there will be any depreciation that has been subtracted from this particular case to get that net present value, to get that profit given there, we need to add back so that we get the correct cash flow. Correct? Now, let's see. A fixed cost include an annual charge of 4 million for depreciation. So therefore, in the fixed cost of 10 million for year 1, 10 million for year 2, and 8 million for year 3, it has the depreciation. Depreciation is not the actual cash outflow. So what do we do with it? We need to add back for us to get the cash flow, Therefore, the profits given there of 15 million, 20 million, and 6 million, that is now the profits for the period. But that is not the cash flow. For that case, for the cash flows, we need to add back the depreciation of 4 million on each profits. Then at the end of the 3rd year, that is the 3rd year, you can see there, the working capital investment would be recovered and the equipment would be sold for 5 million. Let me explain this. When you talk about a working capital at the beginning of the year, it is the cash outflow. But a working capital at the end of the year is the cash inflow. So in this case now, the working capital of 20 million at the beginning of the year will be part of the cash outflow. Then we are being told here at the end of the 3rd year, we will recover our working capital. That recovery is like a cash inflow, but at the beginning it was a cash outflow. Therefore, in simple terms, we are saying in year 3, we will take the profits given of 6 million plus the depreciation for me to get the cash flow. Then I will add back my working capital because I'm recovering in year 3. So therefore, that is the principle here. Then they are now saying, okay, sold at 5 million. So again, we have been told that in this case again, the working capital will be recovered. And the equipment that we bought at the beginning of the year is again being what? Disposed. So when we are disposing an asset, we will get now a cash inflow. In this case now, it means on the same particular period, that is in year 3, we will add depreciation to the profit given. We will add the working capital at the end of the period. Then we will add our proceeds from the sale of this particular equipment. So simple. So yours is to interpret the questions correctly. So let's see now. So we have here how many years there? Here. So I can use the same years here. So we are 1, 2, 3, 4. So it will go still with the period, but the cash flow will be different. So I will bring here the cash flow. I will bring here the cash flow. Okay. For year one, the cash flow for year one is net profit first of all is 15. Profit is 15. I will add 4. So your answer is 19. Cash flow is 19 million. In year 2, it will be 20 plus 4. I will get 24 million. Then in year 3, I will take 6 plus 4 plus the cash flow of 20, working capital of 20, and then you add 5 million for disposal, so that you get now the correct cash flow. So when you add that for the year 3, you will get 35 million. So this one will give you 35 million. So I have my cash flow. That's what you are supposed to do. So any depreciation given, you add back for you to get the cash flow. Once you have this figure, you now get present value interest factor. You can see the period starts for 3 years, right? That is for 3 years, not for 4 years. 3 years. So from year 1 to 10, it will be 12%. So it will fall within 12%. So which means it will be the same as this, 0.8929, 0.7972, and 0.7118. Then you get the present value. So it will be the cash flow times a discounted figure, cash flow times the present value interest factor rate, then you get the answers. So the answers, when you press your calculator, well, you'll get here 16.9651, 19.1328. Then this one will give you 24.9130. So when you add these, you get now the present value cash inflow of how much, class? 61. You get now 61.0109. Like that. $109, like that. So let me test. This plus this is 5, 8. So this is 8, sorry. That is 8, 9. So therefore, that is what you are supposed to do. From there now, we now calculate our present value cash outflow. What is the present value cash outflow here? So from our question, we are told B, that there will be 44 million on capital equipment. You buy the capital equipment, the cash outflow. Then there is 20 million working capital at the beginning of the year, which I've just explained by saying this one will form part of the working cash outlay. So in this case, it will be now 60. We have now 44 plus 60. 44 million plus 20 gives you 64 million. So you get 64 million. So when you subtract this, what is your answer? When you subtract, you get a negative, right? Which means the net present value for this particular project is a negative of 2.9891 negative. Project C. Project C. It would involve a cash outlay of 50 million on equipment and 15 million on working capital. You can see, so cash outlay will be now 50 million plus 15 million working capital at the beginning of the year is a cash outflow on working capital. The investment in working capital would be increased to 21 million at the end of the first year. So therefore, it means the first year we shall be having an increase of 21 minus 15 will give you 6 million. So it will be an additional 6 million. You see how I'm going to treat that. And annual cash profits would be an annual cash profit would be 18 million per year, at the end of which the investment in working capital would be recovered. Now, from this particular question, we are not being given the period. We are only given information from the beginning of the year, and we are also being told what will happen at the end of the period. So therefore, I think Kasneb made also an error on this particular question, because this particular question we are supposed to know two things. If it is to say this 18 million per year is to go to infinity, we would have been told to perpetuity. From this question, we have not been told to perpetuity. Because we have not been told to perpetuity, it means we have a period, expiry period for this project. So I think Kasneb has to give clarification on this particular question, that this particular project was for how long? We don't know. Now I'm going to use two methods. Method one is to assume this project will last for a certain period of time. I can say maybe 5 years. Correct? Number two, I can also assume and say this project will go to infinity, which it is not possible. The projects don't go for infinity. Correct? When you buy an asset, it cannot go to infinity. It has its own lifespan. So for that lifetime that you have, you need to be given. From this question, I'm going to assume it will last for 5 years. And also, any other person who can answer this question can also say, let me assume this 18 million will go to infinity. And we are all right. Nobody will penalize you on this. So I'm going to assume this particular question will go for 5 years. If that is the case, this is how it should be done. Period here. Correct? So I'm assuming for 5 years. 1, 2, 3, 4, and 5. That is an assumption. Then I can have the cash flow here. So we have been told already in this case that it would involve a current cash outlay of 50 million on equipment and 15 million on working capital. So what will be the cash outflow total? 50 million plus 15 million, that is 65 million cash outflow. But there is an information being given there. That investment in working capital would be increased to 21 million at the end of the first year. So in this case, the first year we have 18 million. If I'm now increasing my cash outflow, it means that this cash inflow will reduce by, from 15 to 21, it is 6 million. So therefore, this cash inflow here will decrease by 6. So the correct cash inflow is 12 million in year 1. But in year 2, 3, 4, correct? Year 2, 3, 4, it will be 18, 18, 18, 18. In this case, it will be 18 million. 18 million. 18 million. But what happens on the last month, the last period? An annual cash profit of 18 million per year, at the end of which the investment in working capital would be recovered. So we shall recover now our working capital. Now, what is the total working capital at the moment? Is it 15 million or 21 million? It is 21 million. Therefore, I will recover 18 plus 21 million. So the recovery amount there will be what? 39 million. So this is my cash inflow. This is now my cash inflow. Then I will say now present value interest factor at the rate of 12% for n years, because I'm assuming now there are 5 years in this case. So for year 1, it will just be the same here. So it will be 0.8929, 0.7972, 0.7118, and 0.6355. But for year 5, I don't have. So therefore, I need to press my calculator also using the same formula there. Using the same formula, your answer you get is 0.5674. Then you say now present value is multiply now cash flow times the discounting rate times discounting rate, like that. When you multiply that, you get here 10.7148. This one is 14.3496. This one will give you 12.56 8124. This one will give you 11.4390. And then the last one will give you 22.1296. Total here will give you present value cash inflow of 71,000,04454. Then present value cash inflow we have already calculated and we have found to be 65. That is 50 plus 15. You get 65 million. So your net present value will give you 6.4454. Correct. Then we go to project D. Project D. Project D. You can see how they are. Project C. Project D now is telling us that we need to go to year 1. So we have the period here. Year 1 also. We have the period here. Periods are this one here for how many years? This is for 4 to 8. So this one is different. So I will now say maybe period here. 1, 2, 3, 4, 2. They are saying 2, 8. Okay. Then I can have now the cash flows here. I can have the cash flows from that particular equation. Now from this particular thing, our work is very simple. Let's see what is happening. Year D. It would involve an outlay of 20 million immediately and a further outlay of 20 million after year 1. It means that the cash outlay will be 20 million. Then in year 1, we shall increase a cash outlay of how much? 20 million. Now the question here is, how are we going to treat this cash inflow that is being introduced in the course of the period? This one will be taken like a loss. So therefore, this amount that is being used in year 1, at the end of year 1, will be treated as what? A cash outlay also, which will be discounted to find out the correct present value of that particular element. Then the cash profits are given there. So our work is very simple now. Okay. So cash flow is given there are 15 million, 12 million, sorry. They are saying year 2, so there is no year 1 in this case. So there is no year 1 in this case. So we have only year 2. Year 2 we have, but we have now year 1 and year. In year 1, first of all, there is, but we have been given an information. In year 1, we have been told there is a cash outlay that was introduced into the organization. Therefore, that one will be 20. Cash outlay means it is a negative. But the 20 million that was given is the cash outlay, which is the present value cash outflow. But this one that was introduced in the first year, will be acting like a loss made by the organization. Yes, it is money that has been taken out, but it's like a loss for our calculation for this case. So it will be like this. So for year 2, it will be 15 million. Year 3 will be 12 million. And year 4 to 8 will be 8 million. Correct? You can see how it is now. Then you calculate the present value, interest factor at the rate of 12% per annum. And in this case, we shall have now the present value at the end. So for year 1, because you are using 12%, you can just copy these ones here. That is 0.8929, 0.7972, and 0.7118. But here, class, pay attention to what I'm going to do. We cannot just bring in automatically because it is telling us that from year 4 to year 8, okay, year 4 to year 8, that is an accumulation. We will not use this formula of 1 plus r power negative n because this is an accumulation, which means that in year 4 it will be 8, year 5 it will be still 8, year 6, 8, year 7, 8, and year 9, 8, no, up to 8, 8 million. For that case now, we need to find out the accumulated discounting factor here. When you go back to my YouTube for the time value of money, you find that when it is accumulative like this, I gave out a formula of 1 minus 1 plus r power negative n. You divide everything by r. Correct? So once you get this, so this formula here, let me use it here. It is 1 minus 1 plus r. In this case, r is our 12, which is 0.15. Then power negative, how many years? 8 years. Yeah, you put here 8, you divide by r. R in this case is 0.12. When you press your calculator, on that particular element, how much do you get? Class, you get something like 4.9676. Is that class? Is that correct? So when it is years accumulative like this, we need to ensure that we use this formula for us to calculate the accumulative discounting value there. Once you have done that, class, already, you see, when I put here 8, it tells me that the accumulation from year 1 to year 8 will be 4.9676, right away from here up to here. Correct? But already I have 4 year 1, year 2, year 3, and here I don't have year 4 up to year 8. Therefore, my work is very simple. For me to find out how much is the value here, I will just take the total for year 1 to year 8, which is 4.967, minus the discounting value for year 1, which is 0.8929, minus 0.7972, minus 0.7118. The balancing figure will be exactly from 4 to 8. Correct? So if you work out that information carefully like that, you are supposed to get something to do with project D. You get something to do with 2.568 like that. Remember, look at my formula. I'm repeating again because I know this is where the mistake comes from. So this one here is for the first 3 years. But if you press into your calculator, it gives up. Calculate using 8 years, it will give you 4.9676. But already inside this, we have this, we have this, we have this. So for me to find out how much is the discounting figure here, I need to take the total minus this one so that I get this. Correct? Then from there, I now multiply and get the answer. So if you multiply the answer, you get is, in this case, you will get 17.8580. This one is negative because it is a cash outflow. Then the second one is 11.958 positive. Then another one is 8. This one, the third here, is 8.5416. Then the last one is 20.5264. If you add this now, the total, remember this is negative. When you are pressing, this is negative. It will give you the figure. It will give you the figure as the figure. And we have also, let me just add here 0 here. Yes, 0 here is the cash inflow, cash outflow. So it is like the cash outflow of 20. You can still bring it here or you bring it here. The way I've just done here, you can still decide to say this 65 can be on year 0. No problem. So nobody will penalize you. If you say this one to be on top here, ensure this one is a negative. So in this case, I'm saying now from here it will be a negative so that I get here negative 20. What will be the present value of this one in year 0? It will still be 1. So it will be 20 times 1, you get that. When you work out all this one, your net present value, because already we have the cash outflow there, will give you 3 point. This is 3.168. That is for year. That is now for project D. Then you go to the last project. Not the last, but the second last project. So we go to the second last project, that is D, so I go to project E. What is the information given for project E? This is a long-term project involving an immediate outlay of 32 million and annual returns of 4.5 million in perpetuity. So I want you to go to project B and see what was happening. In project B, you are not given, not project B, but project C. In project B, C, we are told every year there will be a return of 18 million, but you don't know for how long. That is why I have assumed by saying that one lasts for 8 years. Correct? So for 5 years. So it should be very clear as it is in E. So you to know whether it is to perpetuity or for a certain period of time. So Kasneb, kindly you need to look into that question and advise. Now we move on. So in this question we have already been given the present value cash outflow of 32 million. Then we have been told the return is 4.5 million to infinity. That is to perpetuity. We don't know. Now we need to calculate the present value. So you can see this question is going to teach us a lot. How do we deal with the information when given years to perpetuity? So in this case, our work will be very simple. We can say period here. So the period here is from year 1 to perpetuity. We don't know to which year. So it doesn't have the end. Then we have been told it will give us the cash flow of how much? 4.5 what? Million. Correct? So that is our cash inflow. Now the question here, we have been told we don't know the end. But from the guidance given in the question, from year 1 to year 10, you discount it by use of 12 years. Any year from 11 going forward, it will be discounted at the rate of 15%. So in this case, we are going to say, okay, our workings now will be different. I will now say from year 1 to year 10, what will be my, using the 4.5 million, what will be my what? Present value interest factor at the rate of 12 what? Percent. So in this case, you can see the years are accumulative. So your formula will be 1 minus, into brackets 1 plus r power negative n. You divide everything by r. When you press this one, so n will be 10 years. Correct? So if you press the calculator very well, using the formulas you have there, your answer you're supposed to get there is 5 point. This is 5.6502. From 1 to this one, you get that. So what is your present value? It will be now this times this, and the answer you get there is 25.420260. That is the answer for that. But now we have now from 10, from now 11 to infinity, you will still get what? 4.5. Using that. Now this is where you need to pay more attention. Pay more attention here. If they are saying from 1 to 10, you get this one. The total figure is 25.2.4260. But now from 11 to this one will be infinity. For that matter, you need to find out the correct cash inflow. And the correct cash flow is here is amount over R. R is what? Discounting rate. So when you say now A of amount over R, which is discounting rate, will give you now the correct what? Cash inflow. And once you get the cash inflow, because the figure, we have been told any year above 11 years and above, use in 15%. So therefore, we will not discount the figures we will get here by use of 12%. No, we will use now 15%, sorry. So therefore, because it is to infinity, it will be, for me to get the cash inflow now, it will be 4.5. You divide by R. Which R are we referring to? It is not the 12%, but it will be 15%. That's because it is already above 10 years. So you now divide by 0.15. And your answer is 3 million. Your answer is what? 3 million for that matter. Now, not 3 million, sorry, 30 million. Sorry. 30 million. Now, once I have this figure here, you can see I have already the figures here. So I've already now found that this particular to infinity, I will get this one. What will be my discounting value? So therefore, my work will be very simple. In this case now here, my rate here will be, this one 30 million is at year, we don't know, but for that period. But now we need to take back this one to 11, to 10 years. So therefore, our work here will be 1.12 power negative 10, which will give you what rate? Because I'm taking this one back to where we are supposed to be working. I've already found to infinity to be 30 million. What is this 30 million if we all work to 10 years? So when you work out this carefully, your answer you get there is 9.6592. So you use the 15 years, 15% to get the correct cash inflow. Once you have now the cash inflow, discount that cash inflow by use of the rate that you obtain at the end of the 10th year. The 10th year, not this. This is accumulative from year 1 to 10. What is the discounting rate at the 10th year? So at the 10th year, it is this, not this formula here. So if you press this one carefully, I think you'll get 0 point. If you press your calculator, you get something, 0 point something. Then once you get 0 point something times this one, you get 9 point that. Then you add now. When you add, your answer you get is 35.0852. This is now present value cash inflow. What is the present value cash outflow given from the question? We have been given as what? 32. So you subtract 32 million. So your net present value is 3.0852 million. So class, pay attention to when it is to infinity. Very important. Then we go to the last project, that is project. We go to the last project, that is project F. For the project F, it has also the same element, but look at how I'm going to work out project F. So I have project F. Look at how I'm going to work out. So the same period there, we have been given already the period. From the question, you have been told the period is year 1 to 5, then 6 to 10, then 11 to infinity. You can see. So by the end of this one, you will now be able to know how to work out this one. Then we have the cash flow. From year 1 to 5, you have been given there as 5 million. 6 to 10, we have been given 4 million. And 11 to infinity, we have been given what? 3 million. So this one, we are going to use this information you are seeing here. We are going to apply this knowledge that we have already learned here. Then now say present value interest factor at the rate of 12 what? Percent. So I want us to, let me just do this first like that with the reason. Now, so this one will give you still 0 point. So we had already calculated and we found to be 89 point. It was 89 point what? Not 89, sorry, not 89. It is accumulative from year 1 to 5. From year 1 to 5. So what is the formula here? My formula will be 1 minus 1 plus r power negative n divided by r. This is very important. So when you substitute this for this one, you will get now the figure to be 3.6045. Correct? Then for this one, 6 to 10, you will put here what? 10. When you work out this one, you will get what percentage? If you put now, use now 10 years for this case, you will get a figure. The figure you will get is 5 point. So you will get here 5 point. If you press your calculator very well, 5.6502. That one. But this one is from year 1 to 10. Already 1 to 5 is giving us 3.6045. What about 4 to 6? So it will be subtract. So you subtract this. Okay? When you subtract that, the correct value for this one will be 2.0457. Now you have known now how to go about 1 to 5, this. 6 to 10, when you put 10 on top of this one, you will get this one. But this is not the answer because it is inclusive 1 to 5. So you subtract, you get that figure. Once you get the figure here, I want you to get attention here. This is not the correct figure. So what you do is now you take 3 over r. Remember the formula here. In this case, r is, because it is above 10 years, it will be 15%. So you get now 0.5. So for that matter, if you put there, you get 0.15 there. Your answer is what? 20 million. Correct? Now, when you use now the 20 million, what is the discounting value at that particular period? So you go back to year 10, on year 10th, on 10th, not accumulative, but 10th. It will give you now the correct formula will be 1 plus 0.12 power negative 10. Get that? So if you put now power negative 10, your answer you get there is 0 point. This one will give you 0.3220. You can see now. So the discounting, that is now on your 10th. It will give you this. If you press correctly in your formula, this one here, you get this. But for the accumulative, this, you know now, there are two formulas. When you multiply this one now, your answer you get will be now the present what? Value. So I'll have now the present value for each element. Now the present value for each element, this time is that you get 18.0225. This one is 8.1829. This times this will give you 6.4395. And then you add, you get the present value cash inflow of how much? 32,449. Then present value cash outflow, we are given as what? 20 million. So you subtract your 20 million there, and then your answer you get is net present value of 6 here, 6449. That is how you are supposed to work out A. A was consuming. You are supposed to work out for 6 projects for you to be able to get the correct answer. So that is how you are supposed. So the rest will be very simple now. So now for B, question 3B. Question 3B is very simple. You have just been asked, using calculations in in A above, this one that we have just done from project A to project F. Correct? Advice on the projects to be undertaken. In this case, you only undertake those projects with what? A net present value. So now say undertake projects with the positive Positive what? NPV. E.g., from this question, which one had positive NPV? NPV. So we found that there was only one with a negative. That was project B. So the rest were okay. So you can say e.g. A, C, D, E, and F. So you have your 2 marks. Now C. You have been asked also to, in C, you are supposed to calculate what? Calculate the IRR. Calculate IRR for which projects? A, C, and E. Calculate the IRR for projects A, C, and E. So you need to calculate the IRR. Class, go back to my video on capital budgeting and you will see how I have handled this question on capital budgeting, specifically on these method techniques of evaluating projects. So now let's see. So we have been told we need to calculate the IRR for A, C, and E. IRR for A first. Now, the formula for IRR is given by A plus NPVA over NPVA plus NPVB. Then everything is B minus A. In this case now, A is equals to the lower discounting rate. This one is lower discounting rate. While B is higher discounting what? Rate. In most cases, this is how I advise my students. If you have been asked to calculate the IRR, your work is very simple. What you do, that IRR that you have been given is acting as your lower discounting rate. Now you want to get the higher discounting rate. From our discussion we said IRR is normally on what you call trial basis. We don't know the exact at what point shall we be having these figures. So therefore, I normally tell my student that for us to get the NPV, for us to work out this one, we have to ensure that the second IRR is negative. So not IRR but NPV. The NPV should always be negative for the last one. And how do we go about? So your work is very simple. Your work is very, very, very simple. I normally tell my students that if you have been given, like from this question, the IRR given there is 12% on the lower side. And you have also been given another one as 12%, but 15%, but that is very small. You might get a positive figure. You double the lower IRR. That is the secret. Like for example, in this case, the IRR given there is 12%. So this 12% will be so therefore, our IRR now from 12%, we just double that to give us what? The new IRR, which will be 24%. So in project A now, for this case, in project A, the NPV using 12% gave us what percentage? What profit class? What profit do we get when you are handling A? For the A, we found the net profit to be, the net profit was 1.818 million when it was 12%. Now we want to work out to find out what will happen if I double that IRR. So how here it will be now very simple. You say now here 1, 2, 3, and 4. Correct? Then you say now we have the cash flow here. Cash flow for year 1, 8, year 2, 12, year 3, 10, year 4, 11. Correct? Then your present value interest factor will be now 24%. This is years are following each other. So the formula is 1 plus r power negative n. So if you substitute that, you get the first one will be 0.8065, 0.6504, 0.5245, and 0.4230. correct? Then your present value in this case now will give you 6.4516, 7.8048, and this one is 5.2450, and the last one is 4.6257. Total is 24.1271. This is the present value cash inflow. The present value cash outflow was how much? Cash outflow? It was 29 million, right? So in 29 million. So this one will give you a negative NPVAB. Now this B, this 24% is B. So what is the answer there now, class? So when you subtract, you get a negative of 4.8729. Now, is that the answer? No. What you do now, you come and substitute your formula. A, so your IRR is A, 12%, plus NPVA, it was 1.818 over NPVA is 1.818 minus, it will give you plus. So you just say plus. So you add this now, 4.8729. Because these are negative here, okay class, let me repeat something here. The reason why I'm adding here is because I will say NPVA minus NPVB. Because when I use B as a new rate, it will give me a negative. So a negative and a negative will give you what? A positive figure. So therefore, a positive figure. A positive figure. So that is why I'm adding that. Then you now say B of 24 minus 12. You get your answer. So your final answer, when you press your calculator, your answer you get there is 15.26%. So you are through with the project A. Project C. So the project C, we have also been given there for project C. We used 12, so it will be the same. So I will now say project C. Project C. How many years for project C? It was 5 years. So you can have 1, 2, 3, 4, and 5. What was the cash flow, class? So you go back to how we worked out. The cash flow for year 1 was 12. We worked out that we found to be 12, right? It will be 12 million, then 18, 18, 18, and 39. Remember, I said this one had an issue. No, the B had an issue. No, this was the one that had an issue. We did not know the period, the years. So we assume it to be 5 years. So once you get this one, now get your present value interest factor at the rate of what? Double the rate gives you 24%. So if you put now that figure using 1 plus r power negative n, what is your answer there? So your answer for the first, for project C, will be almost the same as the previous one, 0.8065, 0.6504, then 0.5240, and 0.4230, then 0.3411. Then what is your present value? So this times that, this times that, this times that, this times that. So your answer there you get is 9.678, 11.772, then 9.441, then 7.614, and the last one is 13.3029. If you add, you get 51.7431. This is present value cash inflow. What was the present value cash outflow, class? The present value cash outflow was 65 million. So you subtract 65 million and you get a negative of 13 point. Is it 13 or 6? Yeah, 13.2 12,569. That is your NPV-B. Substitute in your formula, class. Your formula is now A, which is 12%, plus NPVA. NPVA, we found it to be 6.4454 divided by 6.4454 plus this one that you have now 13.2569. Then you say 24 minus 12. So your final answer is 15.93%. So we go to E. We go to the last one, which is now E. Project E. For project E, so your work is also very simple for project E. Now for project E, automatically, we are told the year is 1 to infinity. We don't know. And it was giving us a cash flow of 4.5. That is our cash flow. For that case, we now say from year 1 to 10, what will be your interest factor? So it will be 1 minus 1 plus 0.12 power negative 10, everything over 0.25. Then you multiply by the cash inflow, which is 4.5. You get your present what? Value. So your present value for that case will be 16.5684 million. Correct? Then you now say 11 to infinity, which we don't know. Remember, what did we say for that matter? We say you take what? A over R, which will give you the new cash flow, cash inflow. In this case, it will be 4.5 divided by 0.15, which will give you what? 30. Correct? Is it 30? Sorry. Let me just correct something. Now, for this case now, I want now to deal with, this one will go further to our computation. So therefore, we need to calculate the R first up to 0.15. So for that case, 15% times 2, you get 30. So for that case, here will be 0.3. And this one will give you the figure to be 15 million. I've doubled. Because it is 15%, I double it to give me this. Then from there, I will now need to discount this one by saying it will be now 15 million times 1.12 power negative 10 years. So it will give me the figure as 1.7453 million. Then when you add this, you get 18.3137. This is now the present value cash inflow minus the present value cash outflow, which was 20 million. So it will give you then the NPV to be 2.3137, which is what? Negative. So R will be double because I've already gone above this, above 10%. So it will 10 years, so it will be above that figure. Oh, sorry, here class, let me correct here. This one is 24. I'm doubling, 0 point is also 0.24. So when you work out this, it will give you this. When you work out now using the 30, it will give you this. Then discount it using 24%. That is why you've put using 24%. Sorry, here, sorry, here. It will give you this. Then subtract, you get the answer. Then put now in your calculator. IRR is now 12%, the lower one, plus, what was the original NPV for that case? It was 3.0852, correct? You divide by 3.0852 plus, now this is 2.3137, then you now say it will be 12 minus 15. So if you work out this one, will give you what percentage? If you work out now this, you get that particular answer. So that is how you are supposed to answer that particular question. I think I've covered it very well, this particular question. So if you have any question, kindly reach us also on 0735 346 777. So welcome to the third portion of this particular revision.